Have you ever wondered why the rich keep getting richer while others struggle? Well, it's not just about hard work or luck. It's about understanding money. So let's dive in. Many of us have been conditioned to view money as a finite resource, something that's earned, spent, and often runs out too quickly. We're taught to work hard, save a bit, and hope for the best. But this perspective, my friends, is limiting. In truth, money is more like a seed. When planted, nurtured, and given time to grow, it can yield a bountiful harvest. Like a seed, money has the potential to multiply, to create more money. It's not about having a lot to start with, but about understanding how to make what you have work for you. Now consider this. The rich are not just sitting on piles of money. They are constantly investing, taking calculated risks, and reaping the rewards. Their wealth is not stagnant. It's dynamic, ever-growing, ever-evolving. It's not luck, and it's not always about hard work either. It's about smart work, about knowing the rules of the game and playing it well. So what's the game? It's the financial market, the world of investments, of stocks, bonds, real estate, and countless other opportunities. This is where money grows, where it turns from a single seed into a flourishing tree. But before you jump in, it's crucial to understand that this game is not a gamble. It's not about chasing quick riches or getting swept up in the latest trends. It's about calculated decisions, patience, and perseverance. It's about learning, adapting, and growing, just like your money. So let's reframe our thinking about money. Let's stop seeing it as something that's earned and spent, and start seeing it as something that's grown and multiplied. Let's stop fearing it and start understanding it. Let's debunk a myth. Money isn't the root of all evil. Ignorance about money is. Do you know how to manage your money effectively? If not, don't worry. You're about to discover the basics of money management. First off, let's talk about budgeting. Budgeting is the cornerstone of sound financial management. It involves understanding your income and expenses, setting financial goals, and making a plan to reach them. Think of it as your financial roadmap, guiding you towards your financial destination. By tracking where your money goes, you can identify areas where you can save. Next, let's move on to saving. Saving is the act of setting aside a portion of your income regularly. It's not merely about accumulating money in a bank account. It's also about creating a safety net for unexpected expenses, preparing for future financial goals, and giving yourself the peace of mind that you can weather financial storms. To make saving easier, consider automating it. Set up a regular transfer from your checking account to your savings account. Even small amounts can add up over time. Now on to the third pillar of money management, investing. Investing is the process of putting your money to work for you. It involves buying assets like stocks, bonds, or real estate that have the potential to generate a return over time. The goal of investing is to grow your wealth, not just preserve it. The key to successful investing is understanding your risk tolerance, diversifying your portfolio, and staying invested for the long term. But these three pillars, budgeting, saving, and investing, require one critical ingredient: financial discipline. It's the ability to make decisions that benefit your long-term financial health, even when those decisions are tough or uncomfortable. It's about prioritizing needs over wants, planning for the future, and sticking to your financial plan, even when the going gets tough. In essence, managing money effectively is about more than just making ends meet. It's about building a solid financial foundation that can support you in achieving your financial dreams and goals. Remember, the key to wealth is spending less than you earn and investing the difference. Have you heard of the eighth wonder of the world? It's not a monument, it's compound interest. Let's delve into what exactly compound interest is. In simplest terms, it's interest on interest. When you invest or save, compound interest is calculated not only on the initial amount you put in, but also on the interest you've already gained. This means your money grows at an increasing rate, and as time goes on, this growth can become quite substantial. Imagine a snowball rolling down a hill. At the top, it's just a small ball of snow, but as it rolls down, it picks up more and more snow, growing bigger and bigger. That's compound interest in action. Let's take a more tangible example. Suppose you invest £1,000 at an annual interest rate of 5%. After the first year, you'd earn £50 in interest, bringing your total to £1,050. Now, here's where the magic of compounding comes in. The next year, your interest isn't calculated on the original £1,000. Instead, it's calculated on the new total of £1,050. So your interest earned in the second year is not 50, but £52.50. This might seem small, but as the years roll on, the impact of compound interest becomes clear. If you were to leave that initial £1,000 untouched for 25 years, with the interest continuously compounding, it would grow to over £3,400. That's more than triple your initial investment, all thanks to the power of compound interest. The beauty of compound interest is that it requires no additional effort on your part. It's your money working for you. All you need is patience and time, and the results can be astounding. The miracle of compound interest is not just for the financial moguls or those with deep pockets. It's a powerful tool available to everyone. All it takes is understanding how it works and harnessing its power to your advantage. Albert Einstein once said, "He who understands it, earns it. He who doesn't, pays it." So which one do you want to be? Have you put all your eggs in one basket? If so, it's time to reconsider your investment strategy. Think of your investments like a well-balanced meal. You wouldn't just eat potatoes for dinner, would you? No, you'd want a mix of proteins, vegetables, and carbs to ensure you're getting all the necessary nutrients. The same principle applies to your investment portfolio. Diversification, in essence, is the practice of spreading your investments around. It's about not relying on a single investment or asset class to provide all of your returns. When you diversify, you're spreading out your risk. By investing in a variety of different assets, like stocks, bonds, real estate, and even commodities, you're not putting your financial future at the mercy of one single market or sector. This doesn't mean you'll never experience losses. What it does mean, however, is that you're less likely to lose everything if one part of the market takes a downturn. If you've spread your investments around, the gains from another part of your portfolio could offset those losses. In a volatile market, diversification can be your best friend. It can provide a layer of protection against the ups and downs, the ebbs and flows of the market. And over time, diversified portfolios tend to provide more consistent returns. Now, it's important to understand that diversification isn't a one-size-fits-all strategy. It's not just about having different types of investments, but also about having the right balance of those investments. This balance will depend on your individual financial goals, your tolerance for risk, and your investment horizon. It's also crucial to remember that diversification is not a set-and-forget strategy. It requires regular review and adjustment as market conditions change and as your personal circumstances evolve. So as you venture into the world of investing, remember this: don't put all your eggs in one basket. Diversification is the key to spreading your risk, protecting against market volatility, and potentially seeing more stable returns over time. As the saying goes, don't put all your eggs in one basket. Diversification is your safety net in the world of investments. So how do you build a fortune from scratch? It's not as impossible as it might seem. So we've talked about understanding money, effective money management, the miracle of compound interest, and the power of diversification. All these are key ingredients in the recipe for building wealth from the ground up. But how do they all fit together? Think of it this way. Understanding money is your compass. It points you in the right direction and helps you navigate the financial landscape. It's about knowing the value of money, not just in terms of dollars and cents, but in terms of opportunity and freedom. Effective money management is your roadmap. It's about making the most of what you have and ensuring that every penny is put to good use. It's about budgeting, saving, and investing wisely. It's about making your money work for you, not the other way around. And then there's the miracle of compound interest. This is your engine, the powerhouse that drives your wealth accumulation. It's about making your money multiply over time, turning small sums into substantial amounts. It's about letting your money grow, not just by adding more to the pot, but by letting what's already there produce more. The power of diversification is your safety net. It's about spreading your investments across different assets to reduce risk and increase potential returns. It's about not putting all your eggs in one basket, but instead spreading them out to benefit from different opportunities. Each of these elements plays a crucial role in building wealth. But remember, the key to success is consistency. Wealth isn't built overnight. It's a long-term endeavor that requires patience, discipline, and perseverance. It's about starting small, staying the course, and letting time and compound interest do their magic. Building wealth isn't a sprint, it's a marathon. Start now, stay consistent, and watch your fortune grow. Thanks for watching. Please like, comment, or share this video and subscribe to this channel about personal finance and investing.